What if I told you that banks can create money out of thin air? Not by printing it. Not by finding hidden treasure. And not by taking it from someone else's account. But by simply making a loan. It sounds impossible. After all, most people believe banks work like giant storage vaults. You deposit your money. The bank keeps it safe. And when you need it, you withdraw it. Simple. But that's not how modern banking actually works. In reality, the banking system is one of the most misunderstood systems in the world. And once you understand how money is really created, you'll never look at your bank account the same way again. Today, we're going behind the scenes of the modern financial system to uncover how banks create money, why governments allow it, and why this hidden process affects everything from inflation to housing prices. Let's begin. The biggest money myth. Imagine you deposit $1,000 into your bank account. Most people think that $1,000 simply sits inside the bank waiting for them to come back and collect it. But the bank doesn't keep your money locked away in a vault. Instead, it puts that money to work. Banks are businesses. And like any business, they want to generate profit. The primary way banks make money is through lending. When you deposit money, the bank uses a portion of those deposits to make loans to other people. For example, a family may need a mortgage. A business may need funding. A student may need a loan. The bank provides the money and earns interest in return. At first, this sounds reasonable. But here's where things become interesting. The bank doesn't need to keep every dollar deposited in reserve. And that's where money creation begins. Fractional reserve banking. Let's simplify this with an example. Meet Mr. Mo. Mr. Mo walks into a bank and deposits $1,000. The bank doesn't keep the full $1,000 locked away. Instead, it keeps a portion and lends out the rest. Suppose it lends $900 to someone who wants to start a small business. That person takes the $900 and deposits it into another bank. Now that second bank also has a new deposit. And just like the first bank, it keeps a portion and lends the rest. Maybe it lends $810. Then that $810 gets deposited somewhere else. Then that bank lends part of it again. And the cycle continues. The original $1,000 begins multiplying throughout the banking system. No new physical cash was printed. Yet new money has effectively been created through lending. This process is called fractional reserve banking. And it forms the foundation of modern banking systems around the world. Where does the money come from? This is where many people get confused. They ask, if I deposited only $1,000, how can there suddenly be several $1,000s circulating throughout the economy? The answer lies in how money is measured. When a bank issues a loan, it creates a deposit in the borrower's account. That deposit becomes spendable money. From the borrower's perspective, it's real money. They can use it, spend it, transfer it, invest it, even though the money originated from a lending process. This means banks don't simply move existing money around. They expand the money supply. And that expansion influences the entire economy. In fact, most of the money people use every day isn't physical cash at all. It's digital money created through the banking system. The numbers you see in your bank account represent entries in financial records. And much of that money entered the economy through lending. Why governments allow it? At this point, you might be wondering, why would governments allow banks to create money? The answer is economic growth. Imagine a world where banks could only lend money already sitting in vaults. Loans would become scarce. Businesses would struggle to expand. Homeownership would become more difficult. Economic activity would slow dramatically. Credit is the fuel that powers modern economies. Businesses use loans to hire employees. Families use mortgages to buy homes. Entrepreneurs use financing to launch companies. Without access to credit, growth becomes much harder. Governments understand this, which is why they support banking systems that encourage lending and economic activity. When functioning properly, money creation can stimulate growth and create opportunities. But when it goes too far, problems begin to emerge. The danger of too much money. Imagine a small town with 10 apples. Now imagine everyone suddenly receives twice as much money. What happens? There are still only 10 apples. But more money is chasing the same number of goods. As a result, prices rise. This is one of the basic forces behind inflation. When money expands faster than production, purchasing power can decline. The same principle applies to housing, stocks, goods, and services. When large amounts of money enter the economy, asset prices often increase. That's one reason why housing prices in many countries have risen dramatically over time. Easy access to credit allows more people to borrow and spend, which increases demand. And when demand rises faster than supply, prices follow. This is why understanding money creation is so important. It affects far more than banks. It affects the cost of living itself. Bank runs and financial crises. There's another risk hidden within the banking system. Trust. The system works because people believe their money is available when they need it. But imagine if everyone rushed to withdraw their deposits at the same time. Since banks lend much of their deposits, they don't keep all the cash available immediately. This can create what's known as a bank run. Throughout history, bank runs have triggered financial panic. People fear losing access to their money. They rush to withdraw funds, which creates even more fear. Modern governments attempt to reduce this risk through regulations, insurance programs, and central bank support. These protections help maintain confidence in the financial system. Because confidence is what keeps the system functioning. The role of central banks. Behind every banking system stands a central bank. The central bank acts as the manager of the financial system. It influences interest rates, monitors financial stability, and provides support during crises. When economies slow down, central banks often lower interest rates. Lower rates encourage borrowing. More borrowing can stimulate spending and investment. When inflation becomes too high, central banks often raise rates. Higher rates reduce borrowing and slow money creation. It's a balancing act. Too little lending can slow growth. Too much lending can fuel inflation. Finding the right balance is one of the biggest challenges in modern economics. Conclusion. So, do banks really create money out of thin air? In a way, yes. Not by printing physical cash, but by creating new deposits through lending. It's a process that powers businesses, helps families buy homes, and supports economic growth. But it also carries risks. Too much money creation can contribute to inflation. Too much debt can create instability. And too little confidence can threaten the system itself. The next time you check your bank account, remember this. Money is far more than paper bills and coins. It's a system built on trust, lending, and confidence. And understanding that system gives you a deeper understanding of how wealth, inflation, and the economy really work. Because once you understand how money is created, you begin to understand how the world truly operates.